So macro environments come and go. We've come through a long period of what I would call a Goldilocks stage for equities in particular, where quantitative easing, negative interest rates, and coordinated global growth from last year were all positive for risk. Unfortunately, that world is changing in 2018. We're being confronted with geopolitical uncertainty, whether it's populist politics in the form of the US. Trump trade policy has absolutely changed the world order, particularly the way emerging market countries can fund themselves. It used to be if you needed to borrow in dollars and you had a payment due, you could always trade your way out of that. That no longer is working. The other issue is that the US tax reform has forced some repatriation of dollars back home, and it's caused a little bit of a dollar funding squeeze. Here at GAIM, the last week of June, it's the end of the first half of the year, it's a bit of a problem for the world to get the dollars that they need. And we're also in the midst of some reallocation, rethinking this global growth story, as we've had more than what I would call a soft spot in Europe. And whether this is slowing momentum indicative of a larger recession risk in 2019 or 2020 is really foremost on people's minds. So hedge funds have a lot of problems. First, their performance over the last 10 years, active versus passive problems are foremost. Anyone that's done smart beta has looked incredibly intelligent. Anyone that's been trying to sell alpha looks dumb. But that is changing a little bit. The discretionary global macro guys did quite well in the first quarter, whereas some of the passive folks have been hurt. So I do think that there's a little bit of a change going on. The disruptors are really that this quantitative easing, negative interest rate world in the West is absolutely coming to an end. Certainly the United States is leading that. Whether the rest of the world follows is still an open question, and might be an extension of that Goldilocks world that we're talking about. The other factors are in the geopolitical uncertainty leading to volatility in markets, highlighting another after effect of 2008, which is the regulation of banks led to banks getting out of the market-making business as through proprietary risk-taking and having a back book. The lack of liquidity in these markets has not yet caused a systemic problem, but I think we're going to be in for more gap pricing risks, and this puts hedge funds at the forefront of holding positions that might be very valuable to the street, particularly institutions that need to get out. And that transfer price is going to be interesting to watch in times of crisis, which I think will be coming. I don't want to sound like Cassandra and the sky isn't yet falling, but the hedge fund community has an interesting role to play. The last thing that hedge funds have had is a little bit of a the rich get richer and the poor get poorer, i.e. money flows into hedge funds have been really going to the bigger players. So the niche players have suffered a little bit in the last 4 to 5 years. And I think that there's now a focus on niche and alpha again. I believe that we might be in for a period of M&A in this industry. Not that mergers and acquisitions in private companies get complicated, egos get even more complicated. But I'm optimistic that the hedge fund community is going to be on the upswing in the next few years. Well, they already are. They're hurting markets in growth. Growth expectations have changed. Global supply chains are changing. The valuations of companies are changing. Those three factors lead to more uncertainty, lead to more volatility. And I'm beginning to think that that shift in growth outlooks is leading to a more dramatic position unwind than we started with at the beginning of the year. The other factor is that the value of the dollar changes. In some ways, if the US gets what it wants, the value of the dollar is going to continue to go up. And whether that helps or hurts the world is a question of whether the dollar is the reserve currency and funding currency for growth. And if it isn't, what's going to replace it? You know, if you talk to the Chinese, they'd like the renminbi to do it. Here in Europe, you'd like the UK or the euro to replace it. It's unclear. So that uncertainty bleeds into markets. So GAIM has a long, great history of getting really smart asset managers together with a smattering of interested investors and really talking deeply about the issues facing the industry. This year is no different. It is perhaps a sign of the times that there are 400 people here, all very excited about their prospects into the next 5 years. So I'm happy to be part of that.